The purpose for this session is to specifically focus on the group tax activities, because of course we have run the general seminars as well as the webinars where we give a complete overview of the entire tax law and the key provision, but we have got certain queries to focus specifically on the group taxation. So the session for the day is mainly for the group queries, but of course you are always entertained. If you have a generic question also about the CT, please feel free to specify it also. So if we have to see about the overview of the corporate tax here, so of course it was started all in the last year. Okay, as and when in Jan 22 the ministry has announced the introduction, and they have issued the consultation document at the beginning of the last year. So the aim is that the corporate tax, of course, would be applicable, and it will be effective from the financial years which are starting on or after 1st of June 23. And of course, it is based on the best international practices, and as we are all aware that we have a low tax rate here also in UAE, which is only 9% itself. So if you are exposed to the other jurisdiction and countries, you very well understand that it is comparatively a lower tax rate in itself. So the application, of course, if you have a financial year which is from July to June, in this case, the corporate tax in your entity would be applicable from 1st of July 2023. And if you are having a financial year which is starting from Jan to December, in that case, it would be applicable from 1st of Jan 2024. So in this scenario, which is your financial year is a calendar year, so your first year on which the tax would be applicable would be the 2024. And of course, as we know that we have 3 quarters after that, so our final tax return can be filed up to 30th of September 2025. So the structure for the CT here is that it would be a federal tax, and it is applicable across all the Emirates in UAE. And the administrative authority, of course, would be FTA, which is already handling the excise and the VAT, and the competent authority who will be issuing the tax laws and other related areas, it would be the Ministry of Finance. Again, it's pretty much similar as we had for VAT. So here I'm just giving a corporate law structure. It is divided into 20 sections. Sections are, you can say, it's kind of broader areas in which you can get a quick reference here in case in future you wish to have a first-hand introduction about the CT, so that, as you can see in chapter 5, we have got free zones and so on and so forth. So it is just a skeleton of the entire corporate law which is issued. So it is only for the reference. Okay, a very high level overview. It is applicable on both the business and individuals who are carrying out the business activity. So we'll see the basic test here. So anybody who is conducting the business or commercial activities in UAE, whether it is an individual or it is a business, except for few entities which has the exemptions, and the key exemption here is for the entities who are engaged in the extraction of natural resources, for example, oil, because such entities are already subject to the emirate level tax. So they are already paying, and they are classified into the exempt activities, into the exempt entities. Just as I'm explaining the exempt area, so we have exempt persons and exempt activities. So exempt persons could be, those are the ones who are specified in tax law, which can include the government and owned entities in certain cases, and then we do have the entities who are engaged into the oil and gas exploration businesses, some of the qualifying charitable organization, and so on and so forth. So If you are a business and if you fall under the exempt category, yes, CT of course will not be applicable. In that case, you are exempted from CT altogether and you will not be subject to CT. But if you do not fall in this category, then of course CT would be applicable. So it is kind of a blanket exemption. So if you fall under the categories of exempt entities, you would be exempted. Else, all entities across the country, including free zone entities, of course, would be required to get the CT registration and ultimately file the tax return also, even if your taxable income is below the first threshold, which is 375,000. If you are an individual and if you conduct a business, of course, you have incorporated a business in your own name, or you are conducting a business activity. So it's very interesting so that you are an individual and you are just conducting a business activity. You may not be having a license up till now. So example, a classic example could be social media influencers who are taking the money from the companies for showcasing the product and services. So it's kind of a business activity. And for this, of course, you can have, a license also. But if you are just conducting the activity without getting, a license, still you would be subject to CT. So in that case, CT would be applicable. Otherwise, if you are just earning your salary income, or probably you are just getting some sort of interest income, which is just on your, you can say, the bank deposit itself. So in that case, CT will not be applicable, or you may just be staying in this country, probably just and you will not be doing any of the business activities. So in that case also, CT will not be applicable. The rates here, we have two rates for inland entities who are incorporated outside the free zones. 0% would be on the taxable income which is exceeding 375K. So we would have our first threshold of income would be 375, the first slab. If your income, which is the taxable income, it's not about the accounting income. You may be calculating the accounting income as per the IFRS, and after that you may be having some adjustments, for example, adjustment for entertainment expenses and so on and so forth. After that, the income which is arriving at it is your taxable income, and first 375K will be charged as zero rate. So 0%. And just to understand, it's not exempt income. Okay, up to 375K is not exempt. So even if your business is earning, probably the ultimate income is only 100,000, you would not be considered as exempt. You still have to file the CT return. The only caveat here is that you would not be paying any CT here, and it would only be 0%. And anything exceeding 375K, of course, it would be a flat rate, which is 9% itself. And on top of it, you would pay the CT. For free zone entities, so of course, if you are a qualifying free zone persons, we have certain conditions in that, and the main condition is that you are maintaining the substance in free zone. And in that case, on your qualifying income, the tax would be 0%. Now, still up till now, we have not been given clarification on the qualifying income. But if we go back to the business consultation document, which FT issued earlier, we can just assume or anticipate that it can be probably the income which is generated from within the zone, or probably from zone to export. So it is just assumption. At present, FTA has not clarified anything, but in future, as and when it would be clarified, on your entire qualifying income, okay, for simplicity's sake, you won't be paying any tax. And anything which will not be a qualifying income, again, flat rate would be 9% here. Now, a question arises here that if I am splitting the income between qualifying and non-qualifying, so how 375K would be applicable in terms of the first threshold? So up till now, FTA has not clarified it. So we can only assume that probably 375K, it may be applicable on the non-qualifying income, but again, we just have to wait and see on this. So if my taxable income, just an idea, if is 400K, as I explained, first 300K, 0 to 375K, it would be 0%, and anything exceeding 375K, which in this case would be 25K, this would be charged at 9% itself, and my final liability would be calculated in this way. Now, once we have done the entire calculation, and if we have paid any taxes in any foreign country with which UAE has a double taxation treaty, and as per that treaty, it is accepted that foreign taxes can be adjusted against the UAE taxes, and you are opting for it, in that case, you can reduce your tax liability here in UAE by those foreign taxes itself. Okay, and moving on. So let's now focus on the tax group provisions. Okay, tax group provisions are, there are few only. Up to now, we have not been given a lot of clarification on that. But as we are getting so many queries, so I thought it would be a great area to only have a focus session only for the tax groups. So in this case, in UAE tax law, we have two concepts. Okay, we have somewhere it's mentioned as only tax group, and in some areas we have the qualifying group. So it's very important to understand the difference between the two. To form a tax group, you have to apply to FTA, where you have a common shareholding of 95% or higher. So in this case, if FTA approves you, you will be called as a tax group, and for all the entities, you will be filing single tax return. The parent company will do the consolidation and file it, and you have the typical exclusion of intra-group income and expense items. So in this case, an approval would be a requirement, and you should have 95% holding. For the qualifying groups, it's very interesting concept here. And it is depending on the scenarios, and it is applicable in few cases where if I'll be transferring the assets within the group entities, which will not be formally included or have got the approval of tax group. The only condition here is that in qualifying group that the shareholding is 75% or higher. I'll explain you the detailed the conditions also, but just to understand that qualifying group, it's only the requirement is only for the holding and few other areas. But for tax group, it is primarily that you will file for a single tax return, and the parent company can do the consolidation, and so on and so forth. So to form a tax group, as we just had a discussion, at the parent company who will take charge of of forming and applying to the FTA, it will be applying to FTA that we want to form a tax group. So here I won't use the word qualifying group, and each entity inside the group here would be called as a subsidiary. It is important to understand that the conditions which I'll be explaining you, all of the following conditions must be fulfilled in this case, which mean that there should be juridical entities, which mean legal entities. Individuals cannot be clubbed into the groups. A common example here is that I may have clients where the local are the owners and having their income from certain sources. It could be sponsorship fee and so on and so forth, and they also have the company. So in this case, the individuals will not be able to group with the other entities, because all persons who are incorporated here can only be included in this group. And the parent or subsidiary should not be included in the exempt persons here. And it should not be, any of them should not be a qualifying free zone person. So apparently most of the free zone entities, they will not be able to be grouped, in this concept. The parent and subsidiary should have same financial year. Again, very important area. The reason is that the parent have to do the consolidation and a single tax return have to be filed. And the accounting standards which will be used by parent and subsidiary, there should be same accounting standard. So apparently, all of them, if they are in UAE, most likely they'll be using, IFRS. So just a caveat here that the financial year and accounting standard should be same, which are being followed. Okay. Next is that the parent company who would be doing the consolidation, it's the responsibility to consolidate. And if there are any, say, losses here, where a newly joined subsidiary will be joining his group, and the subsidiary was independently having its own CT number, and it has some pre-grouping tax losses. Okay, so in that case, the tax losses can be attributable to the income of that subsidiary in this group. Okay, and if a new subsidiary joins an existing group, the unutilized losses of existing group, okay, will not be offset against the income of the new subsidiary. Extremely important area. And if you guys would be advising, or you are the ones who will be handling all this, and if you are acquiring any entity and such entity would be grouped, then in that case, you need to understand that its historical losses would not be able to offset against the income. So it is an extremely important area for those groups who are frequently acquiring the entities or including the entities in their tax groups. And once the group is seized, so on cessation of a tax group, the unutilized losses, if we have any, when the parent company continues to be a taxable person, if the group would be seized, the losses would remain with the parent entity itself. And in case if we are degrouping, and the scenario is that the parent company ceased to be a taxable person, in that case, the tax losses will not be available to offset against the future income of individual subsidiaries. Okay, with the exception that if a new parent company will be joined, and without discontinuation of a tax group, we can continue with the absorption of the historical tax losses for the future incomes of the same group. So it's very important, again, where we are selling out the groups or we are disposing the groups. So we need to understand that if the parent company is ceasing to be existent, we may have a risk that our historical unutilized losses will not be able to offset. There are certain conditions where we may have the reliefs from the tax between the group transactions. So here I'm referring to the qualifying group. So which was the shareholding should be 75% or higher. Okay, and it's not my tax group for which I have taken the approval. So if I'm having any transaction between the qualifying group and I'm transferring any asset or ability, so in that case, I would not be taking or recording any gain or loss, okay, in calculating my taxable income. Okay, which is again an important area, that I may not be a tax group where I've taken the approval, but if I have the common shareholding of up to 75% or higher, I have the option that my intra-group transactions will not be generating any gains or losses if I'm transferring any assets or liabilities between the two group entities. And the conditions, again, all of the following conditions in such cases have to be fulfilled. These should be, again, juridical entities. Okay, all of them should be resident. Again, we cannot include the transaction between the foreign entities and local entities which are part of the qualifying group. And or if it is a non-resident, it should have a permanent establishment here in the state. Again, an important area. So either taxable person has a direct or indirect stake of 75% at least. It could be higher, and it could be a direct stake in that company or via a third party also. So it could be part of the group, some parent and then sub-parent and so on and so forth. So again, it could be a direct holding or it could be indirect holding. Again, he should not be exempt. Any one of them should not be exempt. They should not be are the qualifying free zone persons. Financial year should be same, and accounting standards should be same, again, in this case also. Okay, and now comes the area where I have transactions with my entities which are connected with me. Now here I would not be referring only to the qualifying or tax group, but if I'm having a transaction with the connected persons. So the basic principle here is that all such transactions who are between the related parties, they should be under arm's length principle, which in simple meaning is that if I am charging, for example, a selling price of 100 to my group company or my entity which is having a connection with me, same price I should be charging to all my other customers who would not be connected with me in any way. Okay, and again, it also triggers a very huge topic of transfer pricing. Of course, it is a huge area which I may not be covering here, but again, we have separate experts in our company who are specialized in transfer pricing itself. So in case if I'm having any transaction between the related entities, I need to apply one or combination of following transfer pricing methods. Again, I'm just going to explain you here. Then these are the areas. It is again very high level. Transfer pricing in itself is a huge area. I may not be an expert in that, but definitely we have our team members who are expert in this area. So it could be comparable uncontrolled price method, resale price method. Okay, the cost plus, which is of course the very common area method in our transaction at profit method, and then we have transaction profit split also. So just to be sure that if you are having the entities who are having any connection, make sure the transactions are at arm's length in itself. Now, who can be considered as related entities? Now, here we are not referring to tax group or qualifying tax group. It's not like this. Any two or more national persons who are related within fourth degree of kinship or affiliation. This is all about national persons. So father, son, probably son's son, and so on and so forth. And direct or indirect holding of at least 50% or higher in any legal entity by a national person or any other juridical person. So if my holding is 50% or higher and I'm doing a transaction within such entity, then again the arm's length principle would be it would be applicable. And this holding can be direct holding or it could be indirect with combination of any other person in that whole chain. So For those of you who are having the group, the first thing is that you need to maintain the full organization chart within yourself, that who owns who, and then who are these shareholders combined in each of the entities, and hence see that if it is a direct or indirect holding of at least 50% or higher, and of course, it would be something where you should be taking care of such transactions. Now, in case of individuals, as we just have a discussion, so if I am the owner of a company and I'm just hiring a fresh employee who is my son also, and whose fair salary, if he has been hired by any other entities, for example, 8,000, but I am giving him a salary of 35,000, so it would not be on fair basis, and such expenses may not be admissible by FTA if those are being scrutinized. So transparent pricing is extremely important, and it's not only between the entities, it is also between the individuals. Okay, if I am giving any payment to anybody who is connected, so in this case, as I just explained you, that following persons would be considered as connected to a business. So of course, owner, if you are withdrawing any salary from the business, which is incorporated business, and it's not a business which is just run by individual, in that case, your salary, if you are withdrawing anything, it will also fall in this category. A director or the officer, a related party, of course, and if you are the partners of unincorporated partnership. Now, unincorporated partnership is a partnership where few individuals join hand and start working on a common profit motive itself. So unincorporated entities normally will be treated as transparent entities, which means that the entity itself, the unincorporated partnership itself, will not be taxed. Rather, income will be distributed among all the partners, and each of them would be taxed individually. So all the partners of such entity would also be considered as connected person itself. Tax loss provisions, again from the group angle. So I can transfer the tax losses from company A to company B, or I can offset against the income of another taxable person, where all of the following conditions are. And again, I'm just focusing on the provisions for the tax groups here. Both are juridical entities, of course. Those should be resident. And again, the shareholding, the common shareholding, direct or indirect, should be 75. So it is a very interesting area, where that if I have not been a part of an approved tax group, okay, for which I'm just filing a single tax return itself, I am just part of a qualifying tax group also. In that case also, I have adjusted my losses here. Again, very important area is that such common ownership of 75% or higher must exist from the start of the tax period. So if somebody just joins in between, in that case, of course, the tax losses cannot be shifted. So if I've just acquired an entity where my holding is, for example, 80%, but I have acquired it in between the year, in that case, for such entity, I cannot transfer the tax losses itself. The person should not be exempt. Okay, all of those who are included in this transfer of the losses, they should not be qualifying free zone persons. Again, these are the common conditions. Financial year should end at the same date, and accounting standards again should also be the same. Now, tax losses, when I'm transferring, there is a caveat here, and I can only carry forward it indefinitely. Okay, if same shareholders hold at least 50% of the share capital. from the start of the year in which the tax loss is incurred. So again, an important area, if anybody is planning to sell a company or acquire a company, you should understand that if shareholders will change, or if your shareholding will turn to be minority shareholding after the transaction, and there could be a risk that the loss cannot be offset for future. And in case, even if there is a change in the ownership of and at the end the ownership is less than half, in that case, if the business is still carrying on the same or similar business activity, and of course the new owners can still offset the historical tax loss available, which means that if somebody is acquiring a company and entirely changing the activity, in that case probably you will not be able to offset the historical losses of the entity. Okay, these are all the key provisions of which are applicable on the X itself, on the X group. I'm sure there are so many other areas which once we start dealing it with practically it would be applicable, but I just tried to focus on the key areas and which are applicable for the groups. So we are also having a full day tax session, which is next Friday, which is the coming Friday, where we will be explaining all almost all the key provision of the UAE CT, including the tax calculation plus the Excel template for the calculation. So if anybody of you would be joining it, I'm sure that it would be a great added advantage. All of you would also be receiving a link for that and say registration. Of course, it is a paid training, but I'm sure I can ensure you that it has a lot of information which will definitely be helpful. So let me now just see the Q&A. So I'll be answering them all. In case if anybody still is having some question, please feel free to ask. It may be for the group or it may be just for individual CT. So the first one is that services. Mr. Rahul has asked that services by free zone to mainland, whether it is a qualifying income. Apparently, if we go back to the business consultation document, but I'm sure that in that time, as and when FTA issued it, it wasn't it was something which was not making sense of a qualifying income. But as at present, we don't have the exact clarification from FTA, so I would keep this for future. But if you ask my opinion here, that if you're a free zone entity and if you will be dealing straight away with a mainland income, probably it may not be called as a qualifying income. Okay, and the second one is from Anna. If we paid withholding tax in Qatar, it is allowed to deduct on taxable income. Very good question, Anna. As in UAE, we would be having the withholding tax and it would be 0%. And we are expecting that for all the countries where UAE is having the double tax treaties, if Qatar is one of them, and of course, if you have paid a tax in Qatar, and if you opt for adjusting it here, you can, you would be able to adjust it in your CT ability here. But again, it would be dependent on how the double taxation treaty is specifying it. And also very important area is that if UAE corporate tax law is saying something else and the double taxation treaty agreement is saying something else, the agreement between the countries will supersede in that case. Then we have from Rahul again, registered partnership firm or unregistered partnership firm can form a tax group. If it is incorporated as a registered partnership, I am assuming that it is considered to be a juridical entity. It would be in that case you would be able to incorporate it. As far as the unincorporated partnership, I am assuming as it is a transparent entity and the taxation is I default with the in the hands of the individual owner. So I'm assuming that it may not be included in forming a tax group. But again, we'll wait and see for the specific clarification if there is any. Okay, again the same question. What's the difference between incorporated partnership and unincorporated? Very good question here. It is basically when we join hand and incorporate a company as a partnership, then in that case it becomes an incorporated partnership, and in that scenario it is taxed as an entity. Whereas unincorporated partnership, it could be that we are three partners and we have not formed a legal entity as a partnership. We are just joining hand and doing some business. In that case, such entity would be unincorporated. We call it as a transparent entity. The tax treatment is that by default, the entity, the partnership as a business will not be taxed. The income would be shifted, or it would be taxed in the hands of the individual partners. But also you have the option to apply to FTA and ask for an approval that we do not want to be treated as unincorporated partnership. If FTA approves it, you have the option to again get the okay, then you will be taxed as an entity, and the partners would not be taxed in their own capacity. Okay, the next question is, free zone entity can be a part of tax group? If yes, then will lose benefit of loss offset. Okay, no, as I explained that the qualifying free the entities which are the acting as qualifying free zone person cannot be grouped into a tax. So of course you cannot form a group with them. Rahul, again, whether transfer pricing applicable on non-transaction related parties, whether domestic or international, whether any limit on which it is. No, at present what I understand is that there will not be a limit at all, and it would be applicable to all such transaction, whether it is local or with a foreign connected entities. A person residing in UAE but working as an employee of KSA company or working remotely. Okay, let me understand it again. Person residing in UAE but working as an employee of KSA company working remotely. I may not get the question because it's a statement probably, but I'll just try to answer what I have what I have understood. So you said that there is an employee of a KSA company which is working from within UAE. So it could be very interesting that if he is the key guy of that case, a company, and if he is the one who is making all the decisions. So in that case, such scenario can trigger the concept of the permanent establishment, and the case company may require to get a registration in UAE, because any foreign entity who is effectively controlled from within UAE and it's all decision making is handled from UAE, it may be treated as a local company, and it would be for tax purpose, it would be a resident entity, and its global income will be taxable here in UAE. If you have anything else in this, please you can specify and I'll be answering it. Next question is that whether any adjustment is required to arrive at taxable income due to accounting treatment like fair value, etc., or should profit before tax. Simple and 9%. Okay. See, FTA has not currently specified any specific things in terms of how you make a reconciliation, but broadly you will calculate your accounting profit as per the IFRS. The key adjustments are, first one would be your entertainment expenses. Only half of it is admissible, half of it would not be admissible. So first adjustment would be this. Second is your interest expense is only first you will be subtracting the interest income from interest expense. The balance amount can only be claimed up to 30% of your accounting EBITDA. and afterwards we have certain exempt income and so on and so forth. So all this will require an adjustment, and then finally you can arrive at your taxable income, for which first 375K would be 0%, and exceeding that would be taxed at flat rate. And afterwards you can also have the option to adjust the tax paid in foreign jurisdiction. Then we have another question. We are a subsidiary here in UAE in free zone. No BOD meeting held in UAE. No maintenance record like minutes of meeting is being a qualifying free zone will not be accepted. I believe you're asking that if you are a subsidiary entity here in UAE, I'm assuming that you are subsidiary of a foreign entity here in UAE and you are incorporated in free zone, and you will not be having any of the board meeting held in UAE, and you would not maintain any records here. Will it be a qualifying free zone? See, you have to maintain a substance here, and first and foremost, to maintain substance, at least you have to hold the board meetings here. So we still have to wait and see on this from FTA's clarification. But if we go for a plain reading here, you need to maintain a substance for future to be a qualifying free zone entity here. Okay, then we have, if we have 4 companies on which 95% shareholding, out of which 3 is mainland and 1 is free zone, whether parent company has to form group with 3 companies as tax group, leaving 1 free zone? Yes, you can, because you can only form group with the entities who are outside the free zone. So if you have some other companies also, it's your option which one you want to include in a tax group. So if you want to include only 3, which in this case you can only have 3, and in those 3 also, in case you want to include only 2, you can form the group only with 2, and that's it. Okay, and next is that follow-up question regarding KSA company. Okay, UAE resident employee under golden visa is finance person, just managing finance operations, accounts remotely, not key business decision. Yeah, in that case, apparently your key decisions, if you feel like, if you're able to justify that you would it's not somebody key person who is maintaining this activity here, in that case the permanent establishment will not be triggered here, and the case entity will it will not be taxed here. Hey guys, I hope I was able to answer all your queries. Thank you very much. It was a pleasure seeing you all here. I hope I was able to answer your queries, and if anybody wishes to join future trainings, you can. Okay, I have a couple of more questions, I think. Just give me a second. You're welcome, Anna. If a company earning, I believe it's earning capital gain income only, whether need to file a tax return. Okay, see, the capital gain, it falls in different categories. So if you are having it from UAE entities, then it would be exempt. But if you are having somebody, if you have invested in a foreign entity, in that case, you can claim the exemption only if it falls under the participation exemption criteria, in which a few of those I will explain you, that you should have at least 5% or greater holding, and your intention is to hold it for a longer period of time. In that case, it can be treated as an exempt, otherwise it would be taxed. Thank you, Anna. And whether all corporate company required to take registration of CT? Yes, very good question here. Yes, anybody who is, unless it is exempt and FTA is saying that exempt companies should not be getting their CT, the registration. In that case, every entity, be it a mainland entity or free zone entity, whether earning 0 income or 375K or 80,000 or 3 million, all of them have to get the tax registration and file the tax return. Okay, I believe I've answered this, that yes, even if you have 0 income in it, in a year, you still have to file a tax return. Okay, then another question I have, that person just took license, no activity, no sale purchase, still is yes. Unless until you are specifically exempted based on your activity, you would still be required to get the CT registration and file, a return. It could be with zero income, but still you have to file the tax return. Okay, guys, anything else? I'm available. Otherwise, so nice of you. It was a great session. I really enjoyed. If you have any general comments, you can please give a small feedback in the chat session also. It would be great. Director fee, not other business. Okay. If you can just please give me a bit of clarification here, that you have formed a company and with that company you are only charging the director fee. Is that the question? Probably. Thank you very much. Thank you very much, Rahul. It was great. No company, just resident here. Yes, if it is considered as a business activity, if you are a director for so many entities and you are an expert. Example, I'm somebody who is, for example, a tax expert, and I have been appointed as a director by 810 companies. So in this case, I am probably conducting a business activity and I am earning as a fee for my contribution as a director. In that case, yes, it would most likely be a business activity and you would be subject to getting the CT registration. Thank you very much, guys. It was a pleasure having all of you. Hope we'll be doing some more very specific session in future, and we'll be sharing the text recording also with you guys for your future reference. Thank you very much. Have a good day.